All right. So the things that we need to cover, we should be able to understand how common stocks are traded. We should be able to understand how to value the common stocks. Those are ordinary shares. We should be able to understand the market capitalization rate, the stock prices and the earnings per share, the discounted cash flows and the values of the businesses. Those are some of the themes in today's study. So let's just move on. So the following are the key terms that are very, very important. Yes, that need understanding. And to start with, you have got what are known as the common stocks. So common stocks simply means ownership of shares in a public held corporation. For example, you own some shares in a public limited company. Yeah, so when you own shares, those shares, we call them the common stocks, the ordinary shares, yeah, where you are part of the owners of that company, you get some part of the company by buying shares, okay? We call them the common shares or the common stock. Then a secondary market is basically a market in which the already issued the securities are traded by investors. So for example, when these shares are issued for the first time, they are traded on what is known as the primary market, okay? When the companies issue those shares, they send them to the primary market. When you buy these shares for the first time from the company, that is the primary market, okay?
Yes.
Then afterwards, those same shares, there'll be that time where you're not interested of holding those shares. So you'd want to sell them to someone else. So you sell them in a secondary market. In a secondary market, this is where we buy the shares that were already issued by the companies a long time ago. So we are buying them from the fellow investors. So for example, you own shares in ShopRite. You're no longer interested in owning those shares in ShopRite, whose price is stuck at 64 kwacha. So you want to sell them. So when you sell them, a fellow investor who is interested, there is someone who is interested in owning shares in ShopRite. That one will buy those shares. That market is called the secondary market because you're buying the shares from the fellow investor. Okay, the fellow investor, there is someone who bought them at the first time from the company that issued them. That was the primary market. But when you start trading them amongst yourselves as the investors, that is known as the secondary market. Is that clear?
Yes.
Then the dividends basically is a periodic cash distribution from the firm to the shareholders. When the company makes a profit at the end of it all, that profit is divided as the reserves, and the management, of course, the Department of Finance, the finance director, the director of finance, finds out together with the team, they reason together, then they make a decision that they want to sell these shares where they want to sell these shares, they want to share this profit among the investors. So the sharing of the profit is called the dividends. Yes, sir. So I was saying,
yes,
that profit, you want to share it, okay, among the shareholders. But since you shareholders, you differ in terms of the number of shares that you hold in these companies. You're not going to share these dividends, this profit equally. You get it? Others have got more shares. Find that someone maybe just has 500 shares. Somebody has got 1 million shares. Others 15 million shares in a company. So how they share according to the number of shares you have in the company, okay? So that is how they pay those dividends. So for example, they can say, okay, per share, you get 10 kwacha, okay? That is how we're going to share that profit. 10 kwacha per share. So that one who has got 500 shares will just multiply 10 kwacha times 500 shares that he has, that is 5,000, isn't it? Which means we just get 5,000 from that profit. Then the person who has maybe 1 million shares, you know what it means. Or someone who has 5,000 shares, you get 50,000 kwacha as what? As a dividend. So that's how it works. So dividends are basically that distribution from the firm to the shareholders. The price per earnings ratio is called the price. It is found by dividing, okay, the price per share divided by the earnings per share. So price per share divided by earnings per share, it gives us the price per earnings ratio. And what it communicates to us is that how much value does that share earn from the time that you buy that share? How much value is it going to earn by that time the dividends are distributed? Is that fair?
Yes, sir.
Okay. So basically that is what happens. So these are just some of the terms that you need to understand, and you should be fine with them. Then from there we have another conversation. We have another interesting thing, and as we move on, you'll see that there is what we call the expected return. Now, the expected return is basically the percentage yield that an investor forecasts from the specific investment over a set period of time. That is called the expected return. That percentage yield that you as an investor you expect from the specific invest over a set period of time is called the expected return. It is also sometimes called the market capitalization rate, right? So the market capitalization rate is found by saying dividend yield plus the capital appreciation. The dividend yield plus the capital appreciation, whereas the dividend yield is found by dividing the number of dividends divided by the price per share, okay? Dividends divided by the price per share, I bought the shares, okay? This is the primary price per share, how much you bought the share, one share, okay? Right now, the shares in the, what's this? In Airtel is 18 kwacha, as for yesterday when I was checking, 18 kwacha one share. They're around somewhere there. Then in ShopRite is 64 kwacha one. So this is the price that you at which you bought those shares. You divide into the dividends. That is called the dividend yield. Then plus the capital appreciation. Now capital appreciation is the difference between how much the share will be selling right now minus how much you bought it, then divided by how much you bought it. That is called the capital appreciation. So basically, capital appreciation from the practical sense, because these things, when you talk about them in as you reading the notes, they don't make sense. They have to talk about from the practical sense. So what happens is that when you buy shares, for example, in ShopRite, in Airtel today at 18 kwacha one share, then you want to sell them maybe by next year. By next year, when you want to sell them, you find that a share in ShopRite in the Airtel is 27 kwacha, all right? So that simply means that your share has gained the value of 27 minus the 18, all right? It has appreciated by that. The value of your shares have appreciated. That is called capital gain. You say the capital has gained or has appreciated. It's the same thing. Capital gain or capital appreciation. So that is how the investors, hello?
Yes, sir.
Yes, that is how the investors earn from these shares. There are two main ways. Number one is by receiving the dividends that are distributed, obviously, every time when the financial statements have been analyzed and they've seen that they've made the profit. And then the finance department, headed by the director of finance or the financial manager, they decide to do what? To issue out the what's this? The dividends.
Yes.
Okay. But sometimes they can think about plowing back, meaning reinvesting that money back into the business, into the corporation. And so when the capital has gained, it simply means that the share price has what? Has increased. Is that clear now?
Yes, sir.
So that is how you find the market capitalization rate or the market, the expected return. You basically get it from that. So which means the investors expect to earn from dividends. They also expect to earn from capital appreciation. Clear?
Yes, very much clear, sir.
Okay. So from there, we can learn that the market capitalization rate can also be estimated using the perpetuate formula. So the perpetuate formula is this one as given here. So the price, the earnings, the price is equal to the dividend, the number of dividends minus the rate minus the growth rate. Remember now we assume that the growth, these dividends are growing, like they're growing from time to time, they're growing. So you can still manipulate this formula, isn't it? You can still
Yes, yes.
manipulate the formula. You can cross multiply here. When you treat this as a single entity, you have P times R minus what? G equal to the dividends, right?
Dividends, yes. Yes.
Then you distribute P, you have PR, right? Minus
Yes.
PG
G
equal to
is dividend.
dividend. And then you make R the subject of the formula. So we can say first the PR is equal to dividend
Dividend.
plus PG,
Yes.
right?
Yes.
So from there, we are
Have
saying
R.
PR is equal to the dividend. Let me just relate that plus PG. Then we want to make R the subject of the formula. You can divide through by what? By P, right?
Yes.
By P. So that your R can be equal to what?
To dividend.
Dividend over P not
G.
plus D plus G, like that.
Yes.
So I was just showing you what they meant here. So this is basically the same. That's how they are coming up with this other formula here. So that was the rationale. So you can find the return. So sometimes you're given the price of a share, the dividends, the rate of return. Then you are also given the growth rate. Then you're asked to find the rate of return. You can manipulate the formula. Or sometimes you're asked to find the growth rate. You're given the return, given the price of a share and the dividend. Then you can find the growth rate using the dividend evaluation model. This is what it is called. Is that clear?
Very much clear, sir.
Okay. If it is clear, then we can quickly move on to the return measurements. How do we measure the return? So we said the way how we measure the return, we measure them by dividend yield. We've said dividend yield is basically dividends divided by the price earnings per share. Then the return on equity. The return on equity is found by saying earnings per share divided by the book value of equity per share, which is the value of equity per share. That is how we get the return on equity. Now, the dividend discount model. The dividend discount model is about the computation of today's stock price, which states that share value equals the present value of all expected future dividends. I'll repeat. This is a model. One of the models that we use is called the dividend discount model, okay? It's about asking ourselves, what is the value, okay? Or the share right now or the stock price. So the computation of today's stock price or share price, it states that the share value, all right, or the share price equals the present value of all expected future dividends. So in short, they are saying that it's about just discounting the future dividends. You discount them.
Hello?
All right, you get it? So
Yes,
in
sir.
short, you discount the future dividend 1 divided by 1 plus the rate, okay? Plus the other dividend, plus 1 divided by the rate, like that. You discount, okay, the future dividends. You bring them to the present. That is the share price. Is that clear?
Yes,
Given
very
the
much.
future, given the future dividends, given the rate of return, then you can easily to find the present values, and of which we commented last time on how to come up with the present value. Is that clear?
Very much clear.
So basically, this is the model that we have. So the price or the value of the share is dividend divided by 1 plus R, just like that. You understand? Then plus the last one, the last dividends, you sum them plus the price of a share, the last price, and you divide by that, and then you should be fine. An example should be able to help us. There is an example here, right? Let's have an example. So the current forecasts are for the company to pay dividends of 3/4 in year 1, 3/4 24 ngwe in year 2, 3/4 15 ngwe, okay, in for the next 3 years in year 3, okay. And at the end of 3 years, you expect selling your stock at a market price of 94. This will be the price value, the last one at the end, okay? This is the last price, okay? What is the price, all right? What is the price of the stock given 12% expected return? So basically using the previous formula that we had, so it's dividend plus, so it should be 3 divided by what? 1 plus 1.2, right? Yes. We are doing this 12% the return. So 1 plus 0.12, like that, that gives us that. Yes. To the power 1 plus the next one will be what? It will be 3. Yes, divided by 1.
1
plus
point.
1.2, 1.12 squared plus the next one will be this one, since being this one is the last one, 3.50 plus 94.48, then you divide by 1 plus 1.1 12 to the power 3, like that. Then you do the calculations, and then from there you should be fine, right? So this is actually what I was trying to explain. That's how you find the present value, okay? Year 1, year 2, third, discount, and so we have the present value of 75 kwacha. Clear?
Very much clear, sir.
I'm expecting that you understood how to find the present value last time in the previous lecture we had
yes,
that.
Yes, I remember the formula, so I'm able to squeeze in the figure.
Okay, it's fine. So valuing common stocks, if we forecast no growth now, let's forecast no growth, and we plan to hold our stock indefinitely. We will then value the stock as perpetuity, okay? The value to perpetuity, when the stock value, we say it is valued to perpetuity, simply means we forecast that the dividends will not grow, and we will hold these shares indefinitely, meaning we are not going to withdraw them. They will just be there, okay, indefinitely. And so we value like that. The value of the share will be valued to perpetuity. And so that is what is there. So perpetuity, the value of a share to perpetuity is found by saying the dividend divided by R, the returns, which is same as the earnings per share divided by R. Is that clear?
Yes, sir.
Yes. All earnings that are paid to shareholders, those are earnings per share divided by R. You discount them. You know those things. Those are dividends, right? Those are earnings that they're getting per share. You discount them, and you bring them to the present, and you just divide by the R. You remember the formula for perpetuity that I commented on? Like you just divide, maybe 75 divided by 0.12. This is at 12%. You discount that. That's yes, perpetuity at yeah. What about the constant growth model? Okay, the dividend that has got constant growth. So a version of the dividend growth model in which dividends grow at a constant rate is called the Gordon growth model, right?
Yes.
I'll repeat. I'm saying that the type of the dividend where the the dividends are expected to grow, but at a constant rate. We call it the Gordon growth model, right? The Gordon growth model. Now, what about the Gordon growth model? So we know that there is a constant growth in all the dividends, meaning if the dividends will be growing by a certain figure, they will just be growing by that certain figure. And let's say we assume that the same stock paying an initial dividend, that one we just did, okay, previously, is selling for 100 kwacha now in the stock market, selling at 100 kwacha. What might the market be assuming about the growth in dividends? So we are asking for the growth. So the value of dividends is 3 kwacha, dividing by the what? We know that the value of the market price, the market price is the share value in short.
Yes.
So the share value, you remember the formula was the P is equal to the dividend over R minus G. Do you remember this one?
Yes, yes.
So P is the price or the market price of the share. So which is 100. That should be equal to the dividends. The dividends are 3 divided by 12%, right? It is doing at 12%. So that will be 0.12 minus G. And then we solve for G. In short, we're basically making G the subject of the formula. Solving the same way how we were solving previously, right? So just cross multiply, okay? 100 times 0.12, that will be 12, isn't it? That will be 12. And the 100 minus G, that would be negative 100 G equal to 3, right? And we want to make now G the subject of the, G the subject of the formula. Obviously, we will say 12 minus 3 is equal to what? 100 G, right? So that you can say 12 minus 3 is what? It's 9, right? 9 is equal to 100 G. And you divide through by 100 to get G, right? So that your G can be equal to 0.09, which is same as 9%. Is that clear?
Very clear.
So that is when we assume that the growth in dividend is constant. All right? So if a firm decides to pay a lower dividend and they will invest the funds, then the stock price may increase because future dividends may be higher. Okay? Yes. So that is if the firm plows back, that is what it means. The technical term we use is plowing back. Okay? Yeah, when the firm invests money back. So what we expect is that it just pays the lower dividends right now and invests more money. Maybe they just give 20% of the dividends, but more money is invested back in the corporation. The assumption is that the share price or the stock price of that company or the corporation will increase because the future dividends may be higher. Now, okay, they are not paying more dividend now. We know that in the future they may pay more. Okay, more of those dividends. So most of those companies, that's the rationale, that do not give out shares sometimes, dividends, they reinvest the money back. So that more people can now see the value. When you invest more money in your business grows and it becomes interesting. Many people would want to own shares in that business. You're following, eh? So as people demand that to be part of the owners of that business, which is fast growing, what will happen is that the prices of those shares will become very expensive. They will go up, yes, because of the demand. I think you have gotten the rationale behind that.
Yes, sir.
The payout ratio is a fraction of earnings paid out as dividend. Okay. The percentage of earnings that are paid out as dividends is called the payout ratio, okay? The percentage of the earnings that are paid out as dividends. Okay, now the fraction of earnings that are retained in the business, that's called the plowback ratio. That's why when you have the earnings, you can decide, should we pay dividends or we plow back? We retain the money in the business. We retain these earnings in the business, okay? So the exact type was time to decide out of the money that we have, maybe you have 100%, you say, okay, 60%, let's do what? Plow back. 40%, let's give out the what? The dividend. So it means the payout ratio is 40% and the plowback ratio is 60%. Clear?
Yes, very
so
clear.
That's what happens when you are not given dividends. Just know that people have done what? Have decided to plow back. Those people who entrust in owning, in controlling your company, to be part of the
anyone you are not. Hello.
Yes, sir.
Yes, sir. So any time that you are not given the what, the dividend, you just have to know that you have been given the plowed back ratio.
Yes, like what has happened, just know that mostly the whole 100% has been plowed back.
Okay.
Because what usually happens is that the company might have been, maybe it has got to, remember I said the capital structure is divided into debt and equity, right? Maybe the company had more of debt. Maybe it had got maybe 70% of debt and 30% of equity, which means more of the money that they made was used to finance the debt, which means they just made the little money, and that little money they have made, they have decided to plow back into the business. Even you, if you are owning maybe your personal business, there is that time when your business makes money per month, then you decide, I will not pay myself this time around. I will just use all the money and give back to the business. It means you're plowed back. Okay, that's the idea. Investing back in the business, in short.
Okay.
Yes, sir. Fine.
Okay. Fine.
Growth can be derived from applying the return on equity to the percentage of earnings plowed back into operations. So according to the Gordon growth model, it is said that growth is equal to the return on equity times the plowback ratio.
Okay.
Yes, times the plowback ratio. So the return on equity times the plowback ratio. That is basically that. So which is same as the earnings, because the return on equity, we say the return on equity is found by earnings per share divided by the book value of equity per share, isn't it?
Yes.
The plowback ratio. So it's just a manipulation of the same formula, this one and above. And then you should be fine. And so from there is an example. Of course, the examples usually do it better. So let's have the example. Our company forecasts to pay 5-quarter dividend next year, right? Which represents 10% of its earnings. So they're giving 100%, which represents 100% of earnings. So here now they want to give back all the earnings as dividends. This will provide investors with a 12% expected return. Instead, we decide to plow back. Now, instead of giving out 100%, we've decided to plow back 40% of the earnings at the firm's current return on equity. Okay. So the earnings at the firm's current return on equity becomes 20%. The question is, what is the value of the stock before and after the plowback decision? So we start with it before the plowback decision, right? Starting with no growth first. What is the value of the share? It is dividend divided by the return, which is 12%, right? Without growth, there is no G here. G is 0. That's what it means. So you found that there is 41 quarter, 67 way.
Yes.
41 quarter, 67 way without growth of the dividends. Let's see now when there is growth. Okay. When there is what? Growth.
Growth.
All right. There is growth. So how do we do growth? According to the Gordon growth model, it says growth is equal to the percentage of equity, which is the return on equity. This one, the return on equity times what?
Yes.
Times the probability ratio, isn't it?
Yes.
You remember the previous formula, return on equity times the probability ratio. The probability ratio is 40%. So the return on equity is this one, is 20%. So just multiply 10% times the probability ratio, which is 40%, right? And when you do that, you find the 0.08, which is same as 8%, isn't it? As a growth rate. So in short, the difference have grown. You've seen, I'm using the same formulas, just manipulating them. You've found the growth. They have started, the difference have started growing. So if you growth, let's see what the price will be of a share now. It will be price divided by the dividend, divided by R minus G, isn't it? Minus growth.
Yes.
You've seen the formula. So the difference with the growth now, you are no longer investing the entire what? 5%, okay? What will be your dividend now? The returns on equity is 20%. What is 20% of 5%?
20% of 5%.
Yes.
Of 5.
Multiply 0.2 times 5.
5 that would be 0.2 times it.
0.2 times 5.
0.2 times 5. This will be 3.
It will be 3.
Yeah.
You have proven?
Hello?
Yes. Have you done that calculation? 0.2 times 5.
0.2. 0.2.
5.
2 times 5 plus 0.2 times 5. 1.
Okay. What about 40%? 0.4 times 5.
0.4 times 5. 2.
Yes. So 0.4 times 5 is the retained, right? That's a probability. That is what has been retained. It has not been given as the dividends, right? That's so. What is the 0.6 times 5? Do 0.6 times 5.
So 0.6 times 5, I think should be 0.6 times 5. That's 3.
That is what is given out as what? As the dividends. So to find the dividends are basically given by saying the return on equity, the percentage that has been returned, that has been given as a dividend. Sorry, the dividend ratio. There is a probability ratio and the earnings ratio. So there is that what has been given, the dividend ratio multiplied by the dividends, the initial price per dividend. So right. So 40% has been plowed back, isn't it?
Yes.
Hello. 40% has been plowed back, which simply means 60% has been what? Issued as dividends.
Yes.
Yes. Out of 100. So 60 has been given as dividend. So it says 0.60 times this price of a dividend 5, that gives you 3. That is what you put here under dividends now if you brought. Let's say 3 divided by the return is 12%, 0.12 minus the growth you said is 0.08. And you go on, you will find the 75 with growth. Is that clear?
Yes, sir.
Any question?
So far, no.
You're following, eh?
Yes, sir.
Okay. Now, if the company did not plow back, some earnings, the stock price would remain at what? It would, you've seen, the price of a share would have remained at 41. But because of the fact that they had to plow back, the share price rose with growth now. Okay? It rose to what? 75.
75.
So this is what it means. Mostly, we are just proving the theory that always once you plow back, when they plow back, what happens afterwards? The earnings go upward. Okay. For example, who is this one? Zanaco. Zanaco didn't give out the shares in in December this year.
Okay.
Yes, they didn't give people share like dividends, and as a result, the share price increased. It increased from where it was. It increased close to about 1/4 way. Right now, it is increased from where it was last year. It has increased. So whenever you plow back, there is that increase. In short, I'm trying to make things practical so that you can not memorize. The idea is that you should not memorize. You should understand.
Okay, sir.
So the difference between the two numbers, 75 kwacha minus BC, the 33 is called the present value of the growth opportunity, PVGO. The difference between that amount, the price of a share when you plow back minus that one when you have not yet plowed back, it is called the present value of the golden opportunity, or the present value of growth opportunity, PVGO. You got it?
Okay. Yes, sir.
Okay. The corporate finance manager, Mr. Vincent. Present value of the growth opportunity, PVGO, net present value of a firm's future investment. Now, the sustainable growth rate is equal to the steady rate at which a firm can grow. That is called the sustainable growth rate. The steady rate at which a firm can grow is given as the plowback ratio times the return on equity. You get it?
Yes, sir.
That is the growth. So that's according to the Gordon growth model, which gives us that the returns on equity, right, times the plowback. The plowback is the percentage of the money that the profit that remains to be as the return, then it's in short, times the return on equity, and then you have the growth rate. Is that clear?
Yes, sir.
Okay. The investment rules are as follows. You can use the net present value, the payback period method, and the internal rate of return to always calculate to use as the guiding as you decide. You remember what I said about the net present value last time in the introduction? I said you basically subtract the present value of those future cash flows minus what you invested, the initial investment. Okay, that's the net present value. So you get the future value, those forecasted future values. You remove what you invested. What you get is the net present value. Should it be positive, you can invest in that project. If it is negative, it means that this initial value, the required investment that you invested is more than the present value, isn't it? The return, the cash inflow. So you don't invest in the project. So this is the formula actually for net present value. So it is the C naught, which is always negative. This is cash outflow. The money that you invest is called cash outflow. Plus the future, the present value of the future cash flow plus divided by 1 plus you know that this is a discounting factor. You're trying to bring it back. So the present value minus this one always carry a negative sign because it's cash outflow. This one is the cash inflow, like it is coming to the business. Okay. Yes, sir.
Okay.
Yes, this one is cash inflow minus what you invested. Then you check, is the answer positive or negative? If it's positive, well and good, you can invest. If not, you do the opposite. An example can always do better. Okay. The simple rule is you accept the investment if there is a positive NPV and you reject if there is a negative. That's what it means. Suppose we can invest 50 kwacha today and receive 60 kwacha in 1 year. Should we accept the project given a 10% discount rate? So this 60 kwacha should be discounted this in the future. Bring it to the present. So cash flow you have invested today is 50, say you say negative 50, because that is the OC. I said your C is always negative. C subscript O. Plus the present value of 60 at 10% would be 1.10, right? You discount that.
Yes.
Then you get the 4.55 positive. Observe that your answer is positive. Because the answer is positive, it means that the cash inflow is higher than the cash outflow. What that means is that the net present value is positive, which means what you receive from the investment is higher than what you invest. So you can invest in the project. Is that fair?
Yes, sir.
Hello? All right.
Yes, sir. I can hear you.
There is also that one we talked about, the present value, whatever. So I'm sure you're conversant with it. The payback period method. Sometimes investment have to pay off within the specified time limits, okay? So a particular cut-off date is defined. All investment projects that are able to recover at least their initial investment within that period are accepted. Then others that give outside are rejected. And so we have an example, an illustration, so that you can understand. In year 0, this is where you make investment. There are 3 projects, project A, B, up to C. Project A, you have invested a 2,000 kwacha, that's why it is negative. Then in first year, you receive a 500 kwacha from that investment, 500 kwacha in the second year, 5,000 in the third year. What is the payback period? The payback period is that time, okay? That time at which the investment is able to give back everything that you did what invested in. Okay. So for this one, you can see that in the first year, it has just given you 500, but you invested a 2,000. In the second year, it has made now 1,000. In the third year, that's when you have it recovered all what you invested in, right? Then the third one, the investment B, first year it gives you 500, 180 in the second year, so it has got 2-year payback period. Project C, it gives you 180 in the first year and 500 in the second year, so which means it has got 2 years payback period. So if you have to choose which investment to get using the short payback period, you can always go for those whose payback period is shorter, those investment projects.
Yes, sir.
You get it?
Yes, I get it, sir.
Yes. You can see that if you use the net present value method, this one shows that this one has got a higher profit, right? Project A. So you can always, using NPV, net present value method, you can go for this. But using the payback period, you can't go for it because it takes a lot of time for it to give back all the money that you invested. So that's the idea.
So such investments, you don't have to go for them or what?
No, the advice is that you're always advised to invest in those investments whose payback period at least is short. It's not very long. The payback period is just that time when the investment is able to give back your money. There are people who undergo the investment. Hello?
Yes, sir.
There are some people who invest in projects that are that will never recover the money in their lifetime. You understand?
Yeah, it's true.
Example, you are, let's say you are 50 years. Okay? You are 50 years, or let's say you are 60. You are 60, you want to invest in a house that has costed you 2 million. The cost is 2 million of that house. Then you want to put someone to rent that house at 10,000 per month. Are you sure you manage to recover the money in your lifetime? You understand that it will take maybe about 25 years something for you to recover everything, all the money that you before you make profit. Because when you build a house, it doesn't mean when you receive the first rentals, you've started making profit. That's wrong. Like when first that house is able to recover everything you invested in building, all the costs, then afterwards, that's when you make profit. So you find that some investment, they will give you money in a long run. Maybe you won't even be there. Those people who will remain, you understand? So I'm not saying it's bad to build a house. I'm just giving you an example. So basically, you have to analyze these investments, right? And now is 14 hours the time. Just 1 minute. I'm asking for a minute. Hello?
I can hear you.
Yes. Yeah. So to end the lecture, there is the last one, which is the the internal rate of return. All right. The internal rate of return. Yeah. With the internal rate of return, just I'm asking for not more than 3 minutes will be done. Okay. Yeah. Yes, this is the internal rate of return method. You've seen the way how it is. This is the formula. So there is a question down here. The question is here. Okay. They are saying that a project with an initial investment of 4,000, it leads to the following cash flows. So this is what you invest. The cash flows will be 2,000 at the end of first year and 4,000 at the end of second year. What is the internal rate of return, IRR? Then the question is that solve the equation, this equation. You have to solve this equation. They have already shown you how to do it, but they are saying that to show that the answer, prove that the answer is 28%. That's what you have to do. You just have to prove. So how to go about this one quickly? You have to replace this ARR with maybe X. Let's say you can say let IRR equal to what? To X. Okay. Yes. Let IRR equal to X. Or let 1 plus R. Sorry, let 1 plus R. Let 1 plus R. 1 plus IRR equal X. So that here you can replace, you can say negative 4,000 plus 2,000 over X, right? To the power 1 plus 4,000 over X squared, isn't it? All that's equal to 0. So from there, you can get this negative 4,000 to the other side of the equation. So it will be 2,000 over X plus 4,000 over X squared is equal to what? 4,000. Isn't it?
Yes, sir.
Then from here, this becomes a fraction, right? Yes. It now becomes a fraction. You can choose the common denominator. It will be X squared, isn't it? X into X squared is X. X times 2,000. It will be 2,000 X, right? Plus X into X squared is 1 times 4,000. It is 4,000. That is equal to 4,000. Is that clear?
Yes, sir.
Then from there, what do? You can cross multiply. When you cross multiply, you have 2,000 X plus 4,000. That is equal to 4,000 X squared. Yes. Isn't it? Yes, then sir. From there, you can easily manipulate this equation and it will lead into a quadratic equation. You're observing that. So it will be a quadratic equation, isn't it? You have negative 4,000 X squared, 4x squared, right? Plus 2,000 X plus 4,000 is equal to 0. Now you have a quadratic equation. Yes. And you're very confident with quadratic equations. You can divide through by 2,000 throughout, isn't it? To reduce the equation. 2,000 2,000 divided by 2,000 and even this side by 2,000 so that you can have negative 2, is it? Yes, 2x squared. plus X, right? Plus C, 2, that equal to 0.
Yes.
Okay.
Yes, sir.
Then from here, it becomes very easy. I think solving a quadratic equation is no longer a problem, right?
Yes, yes.
Those things are not really a problem. Yeah, since there will be some points, so you can use a calculator to solve this quadratic equation. So you find the two values of X. So maybe the first value of X will be equal to maybe 0.275. Okay. Then the other X will be maybe a negative number, negative, okay, negative 0.35, whatever. Now, you say let X be equal to 1 plus what? IRR, isn't it?
Yes.
So what you will do now, this side where there is X, you put 1 plus IRR at the end. So you say 1 plus the IRR is equal to that number. You've seen it, right? Yeah, so when you solve the equation, something like this, there is 1 something here. So one of the answers, I've just extracted one of them, you can easily prove that. And so you want IRR. So you can say 1.275 minus 1. This one here has crossed the equal sign. So that IRR can be equal to what? 0.275. When you round it up to you multiply by 100, it will be 27.5%. That you can round up to 28%. Hence, proven.
Yes.
Any question?
No, sir.
Life made easy.